Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. It's March 5th. Welcome back to the Long-Term Investing Podcast. We got an exciting show as usual. Today, unfortunately, we're going to have to talk about tariffs. I thought we would be able to escape that, but, this is how the world turns. So this will be the all tariff show. Maybe we'll talk a little bit about investing in long-term compounding with stocks. But in the meantime, this is the number one hot button issue. And, we want to tell our clients what we're doing, what we're thinking, how to think through these tariffs, what the impact will be, how it will affect our individual stocks, how it will affect our positioning, and clearly, what we think will happen going forward. Hopefully we can tell you what we think is going to happen going forward. We have no idea. But in the meantime, if you really love this podcast, we'd appreciate if you would give us a 5-star review on Apple, on Spotify, on YouTube. Please subscribe as usual to the podcast on Apple and Spotify and YouTube. We love your support, and hopefully in the next few weeks we'll be doing a review of Constellation Software. Its earnings are coming up, Ernest, as well as to talk a little bit about oil and gas, energy stocks, maybe do another mailbag show. So let's get into the tariff talk. So here we are, March the 5th. Last night, you may have watched the Donald Trump. It wasn't really a State of the Union. It was a speech to Congress, but it acted like a State of the Union. And, it's been a wild, wacky start, of course, to the presidency of Trump. He said he was going to have tariffs. He keeps calling it such a beautiful word. Hard to get that one out. But, the stock market is not reacting so beautifully to these tariffs. Lots of uncertainty. Tariffs are really a tax on goods, a tax on services. Someone has to bear that cost. It isn't the end of the world. We're here to walk you through why there will be winners, there'll be losers, and what we think the best companies in our portfolio, how they'll escape it. So with that, Ernest, why don't you kick it off and your high-level thoughts are about tariffs?
So the way that the tariffs are being implemented is that it is a 25% consumption tax. So goods that are actually being used in the U.S. On goods entering from Canada and Mexico. There is a 10% consumption tax, again, on energy-related products, mainly Canada. So, no, this is only Canada.
Yep.
And that applies to oil and gas, but also things like electricity, uranium, certain critical minerals. There's that are defined in the order. Mm-hmm. And then there's another 10% tariff on Chinese goods. Note that I think it's important to note that this stacks on top of whatever was in place before that. So for things like Canadian lumber, there was already a duty on Canadian lumber. So this 25% stacks on top of that. So now there's like a 50, I think it's a 50% tariff on Canadian lumber.
Whoa.
And the reality is that it's going to be quite painful for some industries. I think prices are going to go up for a lot of goods, and that's before considering the fact that Canada and Mexico have, and China as well, have all announced their own retaliatory tariffs on what the U.S. has announced.
That's right. Or companies, Canadian companies, are taking off their shelves United States products, for example. So limiting it, as they say, no one wins in a tariff war. It's a tax on everyone. The governments will have to bail out or support industries or people that are severely affected. So that's a tax on taxpayers. It's just brutal. And obviously, the longer it goes, the worse it's going to get. Right? In the short term, the impact is negligible. And why do we say that?
Well, why do you say that?
Yeah, well, first of all, because a number of the goods are already held in inventory.
Right, okay.
Companies have already ordered products in advance.
Right, I wasn't exactly sure where you're going with that.
So it's not like all of a sudden today it's a major impact. As it progresses, it does become a major impact. And there will be offsets to each and every tariff or good on a tariff. For example, the Canadian dollar could fall. For example, companies will shift production to other countries, import different products. So I guess the headline sounds horrible. The actual end result is bad, but it's not worth panicking and selling all your stocks for.
Right. And so for the retaliatory tariffs, the way that Canada is implementing it is it's an initial 25% on about $30 billion of goods. So there's like a list of things like I think it's like orange juice and motorcycles and like appliances, and those kinds of things. And, like in many situations, I think demand will just fall because like for orange juice, I don't think you can buy orange juice that easily from other countries. So price of orange juice is probably going to go up, 25% or maybe even more with FX, and demand for orange juice is just going to fall.
Yeah. I mean, the reason why we import orange juice from the United States is that's, it's just closer. Right. So it's the shipping costs of shipping small goods that are low in price, especially when you're shipping liquids, so expensive.
But for other things like chocolate, for example, I don't know if that's under the initial 30 billion, but for chocolate, I think there is abilities for Canadian suppliers to look for alternative sources. So we saw Lindt, for example. Canada's a big eater of Lindt chocolates, apparently. And Lindt is going to move some of its production from the U.S. to Europe.
I always get Lindt chocolates as Christmas gifts.
I think I think I do too.
Yeah.
And so they're going to be shifting some production to Europe so that trade from Europe to Canada is not going to be tariffed. And, so I think that is going to hit the U.S. in more ways than one, because not only are they not only are their products getting tariffed, but they're also losing share to other countries that can now enter into trade agreements with Canada and Mexico.
Yeah.
Right. And then so following this, so that's the first stage. I think the second stage that has been announced is that if Trump doesn't pull back on tariffs, I think it's completely, right?
Yeah.
Then they're going to move forward with a more comprehensive set of tariffs on $125 billion or so of goods. And this is going to be the big one that impacts things like cars and fruits and vegetables and meat.
And that may be happening in a month.
Exactly.
So for now, it's limited tariffs. Not quite sure. Of course, there's minutia of the details. There's de minimis products.
Yep.
How does that work, for example? So I ship a $25 good to you. Is that going to be 25% tariff from Canada to the U.S.?
No. De minimis goods are still exempt.
It's still exempt.
But I don't think those are material.
No, those are. But
to the economy as a whole.
No, they're not material to the economy as a whole. But obviously, to each small business, that's a major impact, and maybe a sigh of relief that that's not happening. So let's dive deep into how this all plays out.
Right.
And we really want to give you some specific examples. Maybe it will give you some comfort. Maybe it won't. This is the initial stages, of course. It can always get worse. We know that. But maybe do you want to talk, Ernest, about a Canadian company, or how do you want to play it?
Well, so I think you can't really talk about these tariffs without thinking about it through the lens of USMCA.
Okay.
which is the free trade agreement that Trump negotiated with Canada and Mexico the first time around.
Yes.
And I think that there's a lot of rhetoric that Trump, likes to portray about, Canada being the 51st state and Trudeau being a governor and all these kinds of things. But you have to remember that he was the one who, wrote the initial free trade agreement.
Yeah.
So
this was a redoing of the NAFTA agreement.
Right.
And this was something that Trump put pressure on Canada and Mexico, put tariffs on to try and renegotiate this deal.
Right.
Yeah.
And I think behind all of the bluster, I think what Trump is really after is that he wants to, improve U.S. manufacturing. He wants to bring jobs back to the U.S. and, and he wants to restore, the balance of trade between some of these countries that maybe you can have your view on whether trade deficits are a good or a bad thing, but that's his objective.
Yeah. You can't change the economy overnight. The U.S. is really a service economy. It doesn't make as much goods. It doesn't have the ability. It imports lower cost goods because that benefits its economy. Do U.S. Consumers want to pay more or less for cars? I think they want to pay less.
So understanding how these the trade flows work between all of these three countries, the tariffs on no dimension make any sense for the U.S. as a country because, so take cars for instance. I think the auto industry is going to basically grind to a halt with these tariffs because a lot of cars that are sold in the U.S. are made in Mexico and in Canada.
Correct.
So now that there's a tariff on Mexican and Canadian cars, the U.S. doesn't have enough capacity to make cars at the same prices that consumers demand. So what's going to happen? Ford talked about this a couple of days ago. The Japanese and the Koreans, they're not subject to any tariffs. So when you put a tariff on these cars, all you're doing is giving a benefit to South Korea and Japan, and maybe some countries in Eastern Europe where they're making cars.
Yeah, Ford F-150. I will just buy a Toyota truck.
Right.
Because the price is going to go up. U.S. has to import the steel, the aluminum, the oil, all these products, as well as find the capacity to make all these cars. Impossible, as well as import all. Keep in mind that U.S. car manufacturing, it's a very lean business.
Right.
They use what's called these wholesalers, these companies like Magna and many other wholesalers or third parties that manufacture the parts for them. A lot of them are not made in the U.S.
Right.
Yeah.
And so if you go back to USMCA, part of the key provisions in USMCA is that it increases the share of content that has to be, of the cars that have to be made in Canada,
US,
Mexico, and US. It makes sure that factories that are employing these people have to be paying a certain minimum wage so that U.S. manufacturing is competitive. And I expect that once the shock factor is gone for the tariffs, Trump's will probably aim to renegotiate some aspect of the trade agreement, which was up for renewal in a couple of years anyways.
Yes, I think it's up for renewal in 2026. And really, if you listen to the words from the Commerce Secretary, Howard Lutnick, he said that's really the goal. We want to renegotiate the USMCA. Of course, Mexico and Canada will say, that was the deal we agreed to.
Right.
You guys wanted to rewrite it, and now you want to rewrite it again.
No, and I think some of the other aspects that Trump has been complaining about. So, for instance, I think he tweeted something about how U.S. banks were not allowed to operate in Canada.
That's a line of BS, pardon my language, because there's 16 U.S. banks operating in Canada right now.
No, but that was a very specific provision in USMCA about how American banks are under the trade agreement, American banks were supposed to have equal access to the Canadian market. And I think they do, right? There's nothing preventing JP Morgan from opening up a bunch of 100 branches. But the reason that they don't is, for other reasons. So
they're not. I think if they're not allowed to take over, for example, National Bank.
Right.
That's the whole issue. JP Morgan is not going to start and build branches and spend a fortune trying to build up its brand in Canada.
Exactly.
Seems a complete waste of time.
But they do provide a lot of commercial banking and investment banking
100%.
services here.
Yeah, 100%.
So, and maybe this is off topic, but did you see that Canada changed its takeover rules?
No.
Not allowed today.
Yeah.
So, like Japan, like they now have a national security designation for foreign takeovers.
I saw that Trudeau mentioned something about that yesterday at his press conference. He's really worried that this will grind Canada down, take advantage of Canada, push us into a recession, and make our companies more possibly be taken over.
Well, I think that's really just about the Canadian dollar, to be honest, and more focused on maybe the oil and gas and the mining sectors, because the reality is like no one's going to take over like Scotiabank, right? Or no one's going to take over BCE, right? These are companies that are already Canadian that it doesn't really make a lot of sense for anybody else to acquire.
Yeah.
But with
with
the Canadian dollar where it is, I think that having this extra layer of protection to ensure that you're not getting sold out at like a weak moment in your country, I think that's really what the aim is.
Very interesting.
But back to the tariffs, I think our current expectation is that this is being used as a trade tool. Maybe there will be some shifting of manufacturing and some things that favor the U.S. a little bit.
Fair enough, but it's not. It can't be an overnight thing. It takes years to design, build, move plants, hire new workers, train workers.
Right.
This is not something that can be achieved during one term of a presidency.
Right.
And so, anyways, I cut you off.
But we'll see what happens, because I think the U.S. already maybe they were looking at the stock market or whatever.
Yeah.
And their portfolios got hurt, but possibly we're going to see a rollback of that, possibly even today.
Yeah, it's hard to know. My expectation is that these tariffs will last for about a month. I think Trump has talked about this April 2nd thing. I think that is really the deadline. If you think about it, because he talks about the reciprocal tariffs, no one wants it to get to that point. So I think that's the deadline. That's the point where Canada, U.S., and Mexico will agree to renegotiate the USMCA and drop all tariffs. So we may be in for a month of pain. We may not be in for a month of pain. Hard to know. Quite frankly, the stock market will dictate how long these tariff wars go on. We saw this in many other crises where the stock market just keeps on plummeting, and it affects business confidence, it affects consumer confidence, it affects the government. I mean, so many things. The stock market always gets its way at the end of the day. And even though Trump says we're in for a little pain, obviously it's a lot of pain if this continues. So that's what I'm thinking. I could be completely off base here, but I think it's going to last for a month. But the market will eventually figure that out. And hopefully we're closer to the end than the beginning.
Well, I don't think the stock market is expecting this to persist.
Yeah, no, there's no chance.
Like if you look at the names of like the companies that are the most impacted by tariffs, so like automakers, like car parts companies, companies that make stuff in Canada and sell to the U.S. They've had a rough year. They sold off initially when it was more serious, when it became more clear that Trump was actually going to enact the tariffs. But on Monday, when the tariffs actually went into place, I think they were mostly flat, right?
Yeah.
So clearly the market is not expecting that this is going to take a long time, or that it's a permanent issue for these companies.
No. Although it does create some scarring and some hesitancy, and we're seeing it already in consumer confidence. We're seeing it in results from capital expenditures, some economic data points where businesses are just holding off on large decisions or M&A. And why would they? It's the same thing as when you call us up and say, I've got, maybe we should hold off on buying stocks here, right? Until the uncertainty becomes more certain. Businesses think the same way, where everybody's really just waiting it out to see how this is going to play out. Of course, in the stock market, as you wait for things to play out, prices can get much more attractive.
And I think it's a really, I think you really have to go name by name to evaluate whether the ultimate impact of these companies, right? So, like one example is like Constellation Brands. Like we don't own the stock. They sell Modelo beer and Corona.
Yep.
They make all their beer in Mexico and they sell in the U.S. And so it's a perfect example of a company that would be highly impacted by tariffs, because not only is your beer going to be more expensive because of tariffs, your competitor's beer is not going up because that's all locally brewed. And so now does having a tariff on your business mean the business is worth zero?
Yeah.
Like I wouldn't go so far.
No.
Because like there's still going to be some demand for Modelo and Corona. Like they sell, like there's going to be abilities for them to, maybe shift some of the manufacturing to the US,
Cut some costs
cut
somewhere.
some costs out of the business, maybe push on some of the costs to the distributors. So that's kind of the exercise that you have to do for every name, rather than making a blanket statement of whether this is a tariff winner or a tariff loser, so to speak.
I think you said it exactly right. You can't just assume that the business of a company is completely obliterated because of it. That was a mistake some people made, of course, during the COVID pandemic, right? When they assumed that no concerts, no one's going to travel, right? So those stocks did get obliterated, but as long as you didn't think it was going to last forever, many of those stocks dropped way too much, right? And so if you look at the airlines, they fell 50 or 60%, or hotel stocks fell 50 or 60%. But their businesses eventually came back, and maybe now even better than it was pre-pandemic, right? And so you lost 1 or 2 years of really good results. For a long-term investor, that impact to your portfolio is de minimis.
No, and I think that's really the key here. And you take another company like Apple, where, if you look at their financial statements, a third of their revenue is the U.S., right? And so you could say, if there's a tariff on their business, it's quite material, right? But if you really think through it, like a large chunk of that is services, so there's no impact to that. They have the ability to, raise prices, because these are fairly, people like to buy new iPhones.
They may eat some of the costs.
Yeah.
Right. So maybe their profits will be lower by a couple percentage points.
Yeah, exactly.
Yeah.
A large portion of their device business, like the iPhone sales, is sold through like installment plans or provided as a subsidy from the carriers. So Apple might not even be eating any of that cost themselves. And then lastly, to the extent that somebody says, it's too expensive, I'm not buying an iPhone today, that's just a product that is deferred down the road, because ultimately you're still going to have to replace your iPhone at some point. So I think once you start thinking about it on all of these elements, so what are the companies that end up doing well in an uncertain environment, whether it be tariffs or whether it be COVID or whether it be like inflation or whatever, right? It's companies that have good pricing power, companies that provide like a mandatory service that people need. It's companies that have high margins, that generate a lot of free cash flow, and companies that do something that nobody else can do.
I'm thinking about Costco, for example, during the pandemic. It wanted to make sure it could guarantee that its goods would come over from China. There was a supply chain crisis, issues with just people being sick. They bought their own chips.
Yep.
Right? They secured their own. They didn't want to rely on anybody. This is why you need to own companies that have great balance sheets, smart management, the ability to adapt, to get around issues and make it work out for them. And of course, at the end of the day, when you look at Costco, sure, it hurt initially in the pandemic, and then ultimately a huge pandemic winner, and still a winner today, right? Because it improved the value of its business. It met some terrible short-term issue to its business that could have been calamitous, and turned lemons into lemonade.
No, I think Costco is going to benefit from tariffs
How so?
because, so first of all, people already trust that Costco has the lower prices than everybody else. So in an environment, we saw this in 2022, when prices are going through the roof, people spend more at Costco because they're getting a better deal, right? If you're getting better bang, you're getting more eggs for the same dollar.
That's right. And you can stock up on eggs today versus having to go back next week and buying more eggs.
So Costco has that going for it. And then the other element is that because Costco carries so few, selections of products inside their stores, right? Like instead of 10 brands of ketchup, there's 2 brands of ketchup, right? They have more ability to maintain prices because if one supplier is impacted by tariffs, they can switch to a domestic one. They can, or they can even pressure the supplier to say, if you don't eat the tariff, then I'm going to switch to the other supplier. And so the price difference between Costco and its competitors is going to increase in this tariff environment. And then the last element is that in an environment where all prices are going up, Costco is still going to benefit because, prices are going up.
Yeah. So that's the end game of tariffs. Unfortunately, could be more inflation. Right. There could be, of course, deflation because people won't buy product A, but you still got to eat, or you still got to drive your car to work. You still got to go to work and make money, right? And so ultimately, there's going to be higher inflation. We saw time and again that the companies, as I said, that have pricing power, that are the market leaders, they win in inflationary environments.
And that's kind of what we've been saying on every episode of this podcast, which is that you want to own good companies because by definition, like a good company is a good company that's going to perform well in good and bad times.
Yeah. I mean, in hindsight, we do have a number of names in our portfolio that have been absolutely slammed because of tariffs. It turns out to be mostly the Canadian ones, but not exclusively. We talked here on this podcast of a few moves that we did in our portfolio to try and, just in case tariffs were going to happen. We got rid of a company called Floor and Decor. We got rid of CN Rail, and traded them for other positions that I think we've added a lot of value by doing that. And we were concerned about tariffs. We can't. You're always going to have blind spots in investing. You're never going to see everything coming. But I think we're so far so good.
I think that summed it up well.
Yeah. So I think we just want to reiterate, of course, to the clients how we're going to think about this and how emotionally and physically you react to what's going on. Obviously, if the end game is to increase manufacturing in the United States, to increase the balance of trade, it's not going to be great for Canada long term. But who knows?
No, for those specific manufacturing jobs.
Yeah.
But I think that Canada is going to benefit in the long term from these, this kind of antagonistic approach that Trump is having towards the country.
For sure. We have to find trade partners. And
because I think Canada as a whole is going to be much more resilient because it was not that long ago that the public opinion was kind of split on whether we should build pipelines and we should be trying to export our oil and gas to Asia or Europe, right? But now I think it's unanimous that among Canadians that we got to get these projects fast tracked, right? I think there's an increased acceptance of and a lot of people calling for things like, we have to improve the competitiveness of our country. We have to increase productivity. We have to cut red tape. We have to cut taxes. We got to attract talent back to the country. And I think it took never let a good crisis go to waste. But I think Canada, in the end, is going to be a more resilient and in a stronger place versus what it was before.
As long as it moves and takes advantage of some of these opportunities that are now presenting themselves for long-term gain. I agree with that. We talk many times on this podcast about the market doesn't always go straight up, and it's in tough times where investors really, their portfolios really shine. Where it's impossible to dance in and out of the markets and to time when the market's going to recover, when there's going to be eventually this good news announcement that these tariffs are over or they're reducing or what have you, right? And so it could be painful for a period of time, but at some point in time, as always, the market is going to figure out that the end is near and the market will start to recover. We can't point out to any specific day. It could be a good news announcement day, or it could just be that the sellers have exhausted themselves. Things have fallen to such low levels that there's too many bargains. It's hard to know, and markets recover in weird and mysterious ways. So as for investors, as fiduciaries for your long-term money, we want to stick exactly. This is another crisis that we're in with, but the same playbook. Own strong businesses with strong management teams that can adapt to complex situations. This is not the time for us to become heroes and start buying smaller companies or trying to buy companies that we think will win as soon as the tariff announcements end. That's not what we're going to do. We're going to take our lumps on a few of those names. I think a lot of the companies that we own are resilient, durable, good balance sheets. Their businesses are not going to go to zero. And so there's really no point for us to take any action whatsoever on any of them. And if need be, we will take action. I think another question, Ernest will say, okay, is it time to get more defensive with your portfolio? Should we move into more fixed income now? What do you say to clients who ask those kind of questions?
Well, I think the question about whether you should be moving more to fixed income is less about like where you think the individual stocks are going to do, and more about whether you it's more of a financial planning question. Yes. And more about is this money that you actually need to survive on and that you can't lose?
Yeah.
Because if you can't tolerate a 10% drop in the market,
yeah,
then probably you shouldn't have that many stocks to begin with in the first place. But as far as the names that we own in our portfolio, I think we like them and we think they're going to go up in like 3, 5, 10-year period of time.
Absolutely. And it's not like when stocks fall that bonds get more attractive, right? Bond yields are lower today than they were a few months ago. Stock prices are lower, which means their long-term outlook is more attractive. Obviously, if you expect at some point these issues to go away, right? And so it's very hard to make changes to the portfolio and think it's a right thing to do. We view investing in stocks, imagine you're buying a business that you can't sell. Think about it carefully. And once you bought that business, pretend that you don't want to sell it and that the fundamentals are, and if you got it right and the fundamentals are going to improve, you're going to make a lot of money. And a lot of our companies, we talked about this in the pandemic, they're waiting for this to happen. They're waiting for market dislocations. A lot of our companies are good acquirers.
Yes.
They're companies that are waiting. There's so much competition for assets right now because the stock market has been good. Everybody's gotten rich. And so they're competing against private equity. They're competing against other companies for acquisitions. And when there's dislocations in the market and everybody's nervous, this is when the guys like Mark Leonard shine or the Jay Hennecks shine, where they always maintained their companies with good balance sheets. And now they're facing less competition for the assets that they want to acquire, and they might be much more active than you think. Even the Warren Buffetts of the world. This is what Buffett's waiting for. If you think that he's sitting on cash because he was nervous about markets, well, now's the opportunity. And I can tell you, Warren Buffett is not dumping his portfolio today because of tariffs. He's already made the changes and probably looking to take advantage from here.
No, I think
he didn't call me that, by the way, and tell me that, but I think we understand his playbook.
Well, the other thing I want to talk about is that I think there's some looking beyond kind of your mix of equities and bonds. I think there's a lot of people who talk about defensiveness as in like, should I own more safe stocks versus more risky stocks, quote unquote.
Yeah.
And I don't actually like, I hear this a lot, but I don't actually know what it means, because it usually is implied to say, should we buy more like, consumer staples types names, or should we buy like, like kind of old school dividend stocks instead of growth,
Yeah.
like tech stocks, right? That's
Yeah.
usually what the framing is.
Well, like I'll cancel my Netflix, but I still gotta,
Pay my internet.
pay my internet. I still gotta eat. I still need all those non-discretionary items, right? I don't need to go to a movie or go to Netflix if I lost my job.
Right.
Yeah.
But like I think, I don't think you want, without generalizing across companies, I would feel more comfortable owning the types of companies that we talk about, like the Netflixes, the Microsofts, the Apples of the world, and the Costcos, because these are, like the best in the world at what they do. And these are growing companies that have like a lot of opportunities for growth ahead of them. Versus if you compare that to, I'm not going to name any names, but you compare that to some of these companies that I look at where, yeah, they might have a good dividend yield, but the core business is growing maybe 1 or 2% a year.
Yeah.
The balance sheet is completely levered. So if interest rates spike, like your earnings are going to collapse.
Yeah.
They, they might be facing competition threats. So pricing is going down. And I think it's no brainer, and they're not even that cheap, right? If you look at it on like an enterprise value basis versus some of these like the tech companies. So it just seems like a no brainer to me.
Yeah. So you may be sitting with some money. It's RSP, your RSP, you just made RSP, you just made a tax-free savings account. Maybe you got your bonus. Maybe you just have excess capital, and you might be saying, well, maybe I'll just wait for things to clear. Well, that's always going to be the wrong move. We're going to tell clients time and again, if you give us funds to invest, we're going to invest it. If we like the stock a few weeks ago at a higher price and now it's lower and it's fallen more than we think that, for whatever reason it's fallen more than the impact of, the macro, we should take advantage of buy that stock, especially if we think we're going to own it for a long period of time. I can't remember what we bought. We own many stocks that we bought 5 years ago, 10 years ago, 15 years ago, 20 years ago. I can't remember what we bought them at for each individual client and what the context was and the environment at that time. All I remembered is we wanted to buy that stock and it was attractive. We're never going to get the bottom of a stock, right? We're never going to get it's wishful thinking. I'm going to get the lowest price of the day or the week or the month, or I'm going to be able to figure it out. You're not. It's impossible. So we want to stick with what's possible. Stick to I think we laid out some pretty good facts as to why we think this tariff war is not really the end of the world. I think those that have been invested with us over the last 5 years have suffered through some much worse things. And those have been with us, especially during the great financial crisis, that was life-changing. So that's really the point. And so if you have questions or you want more detail about individual names, of course, you can always reach out to your portfolio manager at Baskin Wealth, and they'll be happy to talk to you in depth and give you reassurance that this is the process that we're doing of really analyzing our companies, not making fast moves because of market changes is the right approach.
You want to talk about Domino's stuffed crust?
Yeah, well, let's end it. Let's end this podcast on a high note. Domino's finally announced that they're going to stuff their crust like their competitors.
Yep.
I don't know if I've ever ordered stuffed crust pizza. My kids have ordered it before, but is this a game changer for Domino's to stuff its crust? Is it cheese? I guess it's Parmesan cheese.
Yeah. So what stuffed crust is it's basically, you have pizza, but there's cheese in the crust.
Yeah.
And the reason why Domino's didn't have stuffed crust in the past was because it turns out it's actually very hard to make fresh stuffed crust. And the whole point of Domino's is that it's fast and cheap, right? So for the person making the pizza to have to manually stuff the crust, it's a very, very labor intensive process that they just couldn't make it work.
Yeah.
But I've talked about this before, where they created a new dough stretching machine so that it's not a manual process anymore. And with this machine, they're now able to make stuffed crust. And Domino's, on the day that they announced it, they said that apparently a third of people who are customers of Domino's eat stuffed crust, but because Domino's doesn't sell it, they're eating it at other places. So, I don't think it's available in Canada yet, so
No.
I can't try it. But hopefully it works well.
Who says there isn't innovation in pizza? So it's a Parmesan stuffed crust and available, I think, in the United States and hopefully being rolled out to other countries. A Domino's stock, I think, we talked about it on last week's podcast. The earnings were kind of indifferent, but the company's hoping some of these new innovations with the menu, as well as possible deals with DoorDash going forward, will really create more demand. My wife was helping my son move to a new apartment, and they were hungry, and my son loves to order Domino's pizza. My wife kind of rolled her eyes when he asked for Domino's. She had it. She said, not so bad.
Well, I think the misunderstanding about Domino's is you can't compare it to, like artisanal pizza that you're buying at like an Italian restaurant.
Yeah.
Because it's a totally different market. Like, you're not deciding whether to order Domino's or your fine pizza. You're deciding whether to order Domino's or not eat, like just eat Subway or McDonald's. And so, anyways.
Yeah. No, I mean, we owned Domino's for a while, and we've seen them, over the years be very innovative with their menu, right? Launching new chicken wings, launching cheesy breads. I think the next step for them is to improve their website and their ordering.
Yep.
So
big revamp for that.
These little things do add up and do create value. And if there's fewer people ordering Domino's because of the stuffed crust, now they have it, maybe that will boost sales, and we're hopeful that will show up in the stock price. Any impact to tariffs on Domino's?
No, because it's all domestic.
Very interesting, right? So generally it makes sense.
Apparently 70% of customers thought Domino's already had stuffed crust.
Really?
Which I don't know if that's good or bad.
Where were they ordering the pizza from?
I have no idea.
All right. Well, that's enough. We'll hopefully by the time this next podcast rolls around, some of these tariff worries will fade, and we'll be talking about brand new worries. And we really appreciate all our listeners, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.